Welcome to Passive Investors Playbook. I'm your host, Charlie Hardage. In each episode, we'll sit down with successful people that turn to real estate to build and grow their wealth. We do a deep dive into why they chose real estate and what makes it so attractive to them. We explore why people in their industry could also benefit from passively investing in real estate. Whether you're a beginner or an experienced investor, a doctor or a professional athlete, love your job or hate your job, our show is here to help you build a profitable real estate portfolio while maximizing your free time and minimizing stress. So sit back, relax, and get ready to learn from some of the best in the business. Welcome to Passive Investors Playbook.
My name is Marcus Ogden, the owner of Ogden Ventures, LLC, a speaking, coaching, consulting business that helps real estate investors rise and elevate to the next level. We are a proud sponsor of the Passive Investors Playbook, a show that helps individuals learn about real estate investing, knowledge to help them gain wealth in investing in real estate to grow their portfolio. To contact Ogden Ventures LLC, go to our website, www.marcus.ogden.com, or email us at marcus@marcusogden.com. Get in touch with us today. We'd love to speak with you. And again, we are a proud sponsor of the Passive Investors Playbook Show, a show that helps people understand and gain knowledge around real estate investing.
All right, we are back with another episode. My name is Charlie Hardage, and I'm the host of the Passive Investors Playbook. Our show is focused on people that were successful in their careers prior to getting into real estate. Today, I have the pleasure and honor of speaking with Andrew Rosenberg. Andrew works with his family business, Ralph Rosenberg Court Reporters. He's based in Honolulu, Hawaii. Andrew is a serial passive investor that's focused on growing his wealth and spending time with his family. He is the host of the CRE Spotlight, a real estate show, and Simply Sundays, which is a monthly networking meetup event. Andrew has invested in over 30 syndications and has over 3,000 units to his name. He's been investing in real estate for over 10 years, and besides multifamily, he has several single-family homes to his name. Andrew, I'm really excited to have you on the show today. Thank you so much for being here. Can you tell the audience a little bit more about yourself?
Oh, thank you, Charlie. I really appreciate it. We got to go backwards in time. I'm actually a fourth-generation entrepreneur.
Wow.
So my great-grandfather owned a liquor distribution business. My grandfather owned a Army surplus store. Then my father owns the court reporting firm, and now I work with him. And my father's side, his father and uncles, they owned a raincoat company, winter coat company in Minnesota. So it's a different mindset that I come from of entrepreneurship.
That's amazing. So I'm sure you got a lot of that work for yourself from the family and that's been around for multiple generations. I don't know if I've ever heard anyone that has is the fourth generation entrepreneur. So you kind of grew up that way. That was
but I kind of bucked the trend. I went off to college. A lot of my relatives didn't have much college.
Okay.
Then he went and got a master's degree through a corporate job and was happy doing that for a little bit. Then 2000 came along and wiped out the tech sector, and I was working in the finance division of a tech company. And it was actually, I'm glad, it's probably the best thing that ever happened to me. I hated working in corporate. I was miserable. And I called up my father and I'm like, I can get another job, but I don't really want to. I don't ever want to wear another tie again. I hate wearing suits. I hate meetings. I hate buzzwords and political baloney. I was like, I don't enjoy this at all. Can I just come home and work for you? And he's like, yeah, come back. So, flash forward, all of a sudden 20 years later, and my hair got white and got a lot fatter. Still with my father, and really living in Hawaii, and very, realized, geez, wow, how lucky I am. There's not many people get to do that.
So you went away, you moved away from Hawaii to go to school?
Yeah, I went to a little school in Massachusetts, a little tiny college called Babson College. And again, it's an entrepreneurship focused college. It's a business college. And then I worked for Lucent Technologies for a while. And you look young, but for the old farts, they'll remember Lucent at one time was one of the hot stocks, and then quickly went bankrupt and
Oh,
was
wow.
bought out by Alcatel, a French company. And it
Okay.
was a real good crash course experience on how the world works.
So at that point, that was 2000, or around 2000. You did not invest in real estate at that point. Is that correct?
No, no. At that point, I was strictly a stock guy.
Okay.
So since the age of 13, I was buying and selling stocks.
Wow.
Mixed success.
Yeah.
And it was always a crapshoot. You could have a good thesis and nothing happens.
Yeah.
You could buy in a whim and it goes up. It always seemed like there was too much of the whim of others, as much as analysis as I might put into it. I always loved it, enjoyed it, but it was never really something I was looking at like, hey, I can make a career out of this.
Yeah. So you did that. You bucked the trend, as you said, went to school, started with the corporate world. And how long were you in the corporate world?
Oh, not very long.
Okay.
3 years.
Okay.
It was a 3-year program where you would travel to different cities and work in different departments. And, I was lucky enough that, I'd gone through all 3 phases and got my master's degree before the company, went bankrupt. Timing worked out in my favor, thank God.
That's a great story. Not that it went bankrupt, but that you tried to buck the trend. And then after 3 years, you said, I don't know why I'm bucking the trend. And you went and started working in the family business. So if your family was not in real estate, and maybe they were, I didn't hear that before, but they were.
No, not in real estate.
Okay. How did you get into real estate?
It's kind of a funny story. Where do people go to vacation from Hawaii? So my father is kind of an oddball. He ended up buying a cabin in North Idaho.
Oh,
in
wow.
an area that's pretty nice, not far from Coeur d'Alene, which is like a resort area. And every once in a while I would visit him, not very often. I'm not as big a vacationer, but we would go, and every year I would notice, man, there's so many cranes every single year, and the area was getting nicer in this area that was south of the more major city. And it dawned on me as, wow, this place is really growing. And so I would talk to the locals, and they would say a big economic trend for them was Californians retiring and moving there for the tax difference.
Oh, wow.
And the cost of living difference. And you would meet a lot of Los Angeles retired police department or fire workers or just different people. And it started dawning on me, this place is going to make money. So I decided to buy a duplex, and that was 2012.
Okay.
So we got very lucky. We bought it in 2012. We actually sold it last year. So we owned it for 10 years, and we bought it for, I believe it was $215, and we sold it for $525.
Holy cow.
And I actually missed the boat. If I had sold it 6 months sooner, I probably could have got $575.
Wow.
But I'm not going to complain.
Yeah. It's still a nice return.
Yeah. But, over the years of collecting rent and, writing off depreciation and just seeing that steady flow coming in.
Yeah.
And, while you're still subject to the whims of economies and tenants and things, it seemed less speculative than the stock market to me.
Yeah.
I was, once that started going forward, I was like, yeah, let's be willing to do this again.
Wow. That's great. So your dad had a cabin in northern Idaho, and the times you went there, you noticed all the construction. And so you bought the duplex around the cabin, like in the same city, same area?
Well, not quite as tertiary as where the cabin was, but it's not a very big area. So yeah, okay. I bought in where the workforce housing would be, because if it's going to grow, people are going to need a place to live. So I, try to buy in a good location. And at that time, thank God, it was 2012. the economy in that area was still really just recovering from the GFC,
Okay.
the global financial crisis.
Yeah.
So we got it at a very good price back then. Much of this is luck, too, and luck and timing. And I always tell people that luck, I don't really believe in luck, because luck is when opportunity and preparation meet.
Right. Agreed.
You still have to take action. So, you can be the luckiest person in the world, but if you don't take action, it's not going to mean anything.
Yeah, I love that, because I think taking action is something that I did not do well for years and years and years. And I would look back and be like, man, I want to be, somewhere else. I need to invest, need to get into real estate. I just never took action until a few years ago. Why do you think you took action then, not knowing a lot about real estate, not having a background in real estate?
At the time, there was the issue of wanting to have a backup plan to the family business.
Okay.
Well, obviously 10 years later, it's the family business still 11 years later, still doing well. But I just didn't like the idea of ever having all my eggs in one basket.
Yeah.
So instead of plunging even more money in the stock market, and we'd just seen the GFC, right?
Yeah.
So in my mind, the best values were in real estate at that time. And I just really wanted something that, I guess the illusion of more control. They only have so much control in life, but I pick and choose when you're going to sell. You can pick to renovate. You can pick within reason your tenants. It seemed to me like a different play and a new skill. So I was eager to let's try something different.
I love that. Totally agree with that. There's a lot of things you can't control, especially in the stock market, mutual funds. That's several degrees of separation there. But in real estate, you do have a lot more control. You're not totally in control, but you have a lot more control than you do in stocks, mutual funds, et cetera. So why did you choose, real estate in general? You were successful. The family business was successful. I know you mentioned you wanted a backup plan just in case, but why did you choose real estate as opposed to opening up a franchise or the corporate world or anything like that?
Yeah, see, I needed a passive income.
Okay.
The family business is very time consuming.
Okay.
Not even just in time, but in terms of mental bandwidth. So the idea of any extra work with employees or marketing and stuff, that was just not going to work.
Yeah.
My son was born in 2008, so 2012 he'd be about 4. Married with a child, 2 dogs at the time, and a very full-time career. I was like, I need something passive.
Yeah.
So this was definitely willing to pay the property manager. Pretty early on in 2012, it really wasn't a big thing to be a remote investor, but when you live in Hawaii, you just kind of have to get used to things.
So you got into real estate for passive income. Owning a duplex, was that pretty passive with the property management company?
No.
Yeah.
No. For the first few years were awful. I had a terrible property manager. When I first bought it, they actually embezzled money from their clients.
Wow.
I lost 2 months of rent, I think. Tried suing them, never got the money back.
Wow.
Had to evict people early on, had just terrible tenants. One tenant, unfortunately, God bless her heart, she had issues. She was a vet and she had PTSD, and she smashed up my place pretty good.
Oh, wow.
But I don't hold any ill will to her. That was she had mental issues.
Yeah.
Her fault. Yeah. So there was many times over the years, pressure from family members or myself, like, what are you doing? You should have sold. And I kept saying, no, you see things through. It's going to work out. Got a better property manager, got better tenants. Years went by with no problems. Rent was coming in. Got really lucky. My second property manager was amazing.
Good.
To this day, she's probably by far the best property manager I've ever had. She ended up becoming a friend, and she treats her clients like as if they're her nephew or her nieces. It's no joke with this lady. So that really opened my eyes as I owned other properties, the difference of the level of service.
Yeah.
So you realize really quickly after an embezzling property manager, a really hardcore property manager, and then people that just kind of like, well, how little can I do to collect my 8 or 10%.
Yeah.
So that opened my eyes quite a bit to the importance of property management.
Yeah, I totally concur with that, Andrew, because a good property manager can make or break the deal, to be quite honest. And in our apartments that we have bought, we have great property management companies that they're the experts. They're the ones that are doing it day in, day out. So we've been very fortunate. I actually did have to fire a property manager for a single family property that we owned. And just never heard from them. I found out later the tenant had asked to renew their contract multiple times, and they never reached, the property management company never reached out to me.
Wow.
And so it was just, I said, you know what, get out of here. I was a landlord, which I don't recommend, but due to the circumstance, I had like 24 hours to pick a different property manager. Different story. But so you got into real estate for passive income, and the first couple years or so was not at all
Terrible.
passive.
That was terrible.
Did you think, I know your family was saying, hey, Andrew, you're crazy, get out of there, sell it. You don't want to do this. What made you kind of keep pushing on to say, be quiet, I got this? And when did you acquire the next property?
I'm a pretty stubborn person. So, yeah, I just basically said, look, no, once you commit to something, you make it work.
Yeah.
Until it doesn't. So that was kind of that. Several years went by actually, because we had quite a bit of money tied into that property. And then later we realized, wait, there's a lot of debt equity here. So that's, when we started acquiring other properties in other states. It's very hard to invest in Hawaii. The cap rates in Hawaii are really, really low.
Yeah.
I mean, we have three caps running around in Hawaii. It's ridiculous. And then, the average home is 1.1, well, just changed. Now it's like $1 million. It used to be 1.1. It's just the ability to cash flow, to put money down. And remember, this is really before short-term rentals and Airbnb was a big deal.
Yep.
Outside of that, you don't really see too many people in Hawaii really wanting to invest in real estate locally.
Okay.
There's some there's flipping, and there's some people that do other things, but it's few and far between. The average white collar small business owner, or like busy, high income professional, like a doctor or dentist, they're mostly going to buy out of state.
Okay. Makes sense. So you after the debacle, I would say, of the first property management company and the tenant, messing up the home, you stuck with real estate and you got a new property management company in there. And then at that point, it sounds like it was pretty much hands off, pretty much passive. Yeah. Okay.
Pretty good. Every once in a while you're going to get the plumbing bill, or the fan broke or something, but nothing terrible.
Good.
And it was a newer property when we had bought it. It only it built a few years prior. And over the last 10 years of owning properties, I just started realizing, for me, I need to buy relatively newer properties in nicer areas, because I just don't have the patience to get bad phone calls anymore.
Yeah.
And as a remote investor, it's too hard. So I really focus on making sure I get a good property manager, one, but two, it's trying to by design eliminate aggravation, because there's a certain point where you're only going to make so much money in a single family investment if you're not flipping and you're not doing major renovations, which I never wanted to do as a remote investor. I have things to do. I don't have time to manage that. So for the returns you're willing to make in single family, the way I do it, I really can't be having aggravation.
Right.
So for me, those internet sites that have the $100,000 homes in like Kansas City in a C-class neighborhood, those just don't work for me. Like I can't do that. There's not enough return for the aggravation.
Yep.
So I'm better off, buying a nicer house in a A-class neighborhood or a B-class neighborhood, at a higher price that I can actually justify a cost seg study, own it for a number of years, and just not get a lot of calls about, tenants or fixing stuff. I mean,
Yeah.
you're always going to get some calls, but
Yep.
at my stage of life, it's if the property is aggravating, it has to go now. I'm not going to hold any more properties that are aggravating.
Yeah, totally agree with that. It is very interesting that a single family home, even if it's $100,000, $150,000, which I know you're in Hawaii, so that's might be a shed at this point, but
Yeah, I don't think even a shed out here. Yeah.
in other parts of the nation, you could still get a decent home for $120,000. It's rare, but it's so much work. And the overall return, in my opinion, doesn't really justify the amount of work. And I own several single family homes. I've sold most of them. We still have one because it's cash flowing so well and it's totally passive. We're probably going to hold on to that for a while, but I'd love to kind of get your story and what you have to say about going from, single family or duplex to apartment syndications or syndications in general. You have more than 30 syndications, which is crazy. That's amazing. Where did that kind of take place to say, okay, I got to get out of single family or small multis and get into these larger syndications?
Yeah, it's funny. If you get to a certain scale, you end up creating a new job for yourself.
Yeah.
So once you hit too many single family houses, you're going to have to make a decision to I guess there's like 3 decisions. You're going to either have to accept you created a new job. You'd have to march forward and double down on it and build a team or hire a staff or VAs, I guess. Or you're going to start divesting and doing syndications.
Yep.
So for me, I was like, look, I'm not going to create a new job. This is not fun anymore. 2, the idea of hiring a bunch of VAs or hiring a manager and doubling down on it, I was like, no, I don't have the energy for that either. So the only other logical choice was to trim down and get over the trust aspect of, geez, how do I even know these guys? Are these guys any good? Are they really going to take care of these properties?
Yeah.
Are they going to swindle you? Are they going to, offer you low pref rates and then they take on massive amount of risks and they're the ones making all the money, which I see in some syndication deals, which frustrates me.
Yeah.
Sponsors should make money, but at the same point, I don't really like sponsors that kind of just view you as a back to step on. If they just see you as capital, no different than debt, it's not really someone I want to invest with.
So you went, I like what you said, after too many single family homes, that creates a new job for you. You didn't want that route. We already talked about why you got into real estate, because you want the passive income.
Yeah.
So you
kind of defeated the purpose.
Exactly. And you're right. Even with a property manager, you still, from time to time have to answer emails or take calls. And with one property, okay, sure, might not be a big deal. It's also not going to bring in a ton of income. But as you scale and, after 10, 15, 20, 30 properties, now it's an email or a call a couple times a week, potentially, or a few a month. And that's not passive. So you started divesting those. I know when we talked before the interview, you mentioned that you're actually selling 2 homes now. So that'll bring your number down to 7 remaining single family homes. And you're in 30 syndications. And how long have you been doing syndications? I don't think we talked about that.
It's a good question, but it'd be over 3 years. It was, prior to the pandemic. So
Okay.
More than 3 years.
And you've had, go ahead.
No, go ahead.
You've had several deals go full cycle, correct?
No, actually, I'm still waiting for the deals to finish out.
Okay.
Most deals take 5 years. I'm not quite at the 5-year mark. A couple of them, are close to fruition.
Okay. Excited for that?
Yes and no. It's always nice to be done, but at the same point, there's the reinvestment risk. Now you have to put the money someplace, and right now this isn't the greatest market.
Right.
If something was to close today, I would probably be waiting for the distress deals to come up in the market. So there could be some opportunity time cost of sitting on capital, which is fine, but it there's different elements of risk. Reinvestment risk is a risk that I don't think most investors consider. That's one of the downsides about a syndication is theoretically every 5 years or so you now have to reinvest the money, and you're kind of exposing yourself to, if every 5 years I have to reinvest the money, do I make a incorrect decision, or do I make an error? Yeah. Versus if you bought a house and it's in a good location and everything's going fine and you have a good property manager, you could, in theory, hold it for decades.
Yeah.
As long as you reserve, properly for roofs and stuff. But there's different pros and cons of the two types of aspects. I think too often, I see on LinkedIn a lot of people, oh yeah, it's just mailback's money and like just cut us a check and don't worry. And like, no, guys, there's a little more going on here than that. Like, you actually have to do the due diligence and interview the sponsors, and you got to review the financials, and you have to wire the money, and it's a little more. And then then you have to reinvest it again. It's a little more than just cut a check and collect your mailbox money. I don't find that very intellectually honest when people pitch it that way.
Yeah, I know our investors, that invest with us. It's typically not a, hey, just met you, we got a deal, and they put the money in. We have a substantial relationship where we've had calls, potentially multiple calls or met in person. Investors always want to know, or they should always know, like, and trust the sponsors. Because you mentioned something five or 10 minutes ago about how, potentially GPs are out there just kind of for themselves, right? And they use the limited partners, the passive investors, as a stepping stone. There's also property management companies out there, and this firsthand, who embezzle money. And so it is important for passive investors to know, like, and trust the sponsor, and then have some idea of the market. You don't have to be an expert, but to know the market, know the business plan, know the underwriting, to feel, after all, it is your money, right? It's your money. And so you want to make sure that when you hand that money over, you're not going to get screwed. And as a general partner myself, I always try to mitigate risk every turn that we can. Ultimately, there's always going to be issues that come up. And so for myself and my team, we always like being extremely transparent as well. If something's going bad, we like to say, hey, this is, where we're at, but this is what we're doing to fix it. And your other point, Andrew, about, trying to figure out how to reinvest that money. I've actually had that same conversation with several investors over the last probably 6 weeks or so. And I don't know if it's just because of the market that we're in right now, interest rates are really high, or if it's just kind of by coincidence that these conversations have come up. But a lot of my investors are actually looking, I have some investors that look to kind of fix and flip, double their money after 5 years and then go find a new property. And then I have several investors that are saying, look, I want to get my initial investment back, and then I want to hold the property longer term. And that is something my business partner and I are actually looking at doing. You can't just flip the switch on every single property, because there are different business plans. If you're going to hold it long term, you don't want to just, do some minor repairs. You probably want to do some bigger repairs too. And that way, raise a little bit more money up front. Potentially the loan would be different as well, but you want to make sure that the property is going to last for a long time, and not just buy something that you put lipstick on a pig and then refinance and keep it long term. So I know that's something that we're looking at. I don't know if you have some of the deals that you've invested in, if some of the partners are going that route, but that's an option too for you long term.
I mean, a lot of it depends on the target audience. Like if you're 30 years old and you're a dentist, let's just say, you're still in that building building your net worth phase of life.
Yep.
Like, let's say you're a very, very wealthy, 60-year-old. you're not really as interested in building net worth at that point. You've already built the net worth. Now you're already thinking next generation. You're already thinking about your legacy and your heirs. So for a person like that, they're more interested in a really, really great property that's worth keeping, doing, more than one refinance potentially over many years,
Right.
and having a distribution stream for their legacy heirs that could last for a long time. So there's a group of Canadians that I've become friendly with, and they have a totally different mindset than the average American investor. Their clientele are ultra high net worth investors. So they're looking at, lower returns with very, very, very low risk. So they're not going to use a lot of debt. They're going to have higher reserves. They only buy really nice properties, generally speaking, and they plan on holding it for a long, long time. So they don't need to make a big return early on. But they want to just own it for a long time and pay distributions out ad infinitum, essentially. And the nice thing is, when you do a refi, it's a tax-free event.
Yep.
So, like the 30-year-old dentist isn't as worried about taxes as someone who's maybe worth, this is not me by any, let's just make that clear. But if you were a $30 million person, taxes becomes very prominent in your investment decision making. So a tax-free event of a second refinance or a third refinance, very attractive over decades of time. And if you're already at a net worth level where you're able to start succession planning, where you're thinking in decades, not like an American, we think in weeks or months, and we're pretty impatient. It can be a better way to invest, but you have to be able to get to that certain net worth level where you have that ability to invest that way. So it just depends on mixing and matching people's goals is a harder thing. Because Charlie, like when you meet a person and you have multiple deals, you have to kind of figure out what's the right deal for them.
Right.
I'm not gonna, if I was getting a phone call from a 65-year-old widow and she says to me, hey, I'm looking at investing with Charlie and he has two deals, and one's a land entitlement deal and one is a boring cash flow deal. Well, obviously we're going to be taking number two. We're not going to put the widow in a land development deal. She needs to have, a safe, boring deal, and she's going to need, distribution money coming in. Obviously the flip side, it's a 28-year-old tech worker out of Seattle. There's not really much incentive to put him in a boring cash flow deal. He's still building up net worth. He's young, still has a good job. He might as well swing for the fences and do the land development deal. So I think that's one of the big things about this industry is when I meet capital raisers that are too salesy, immediately it's just a dead for me. It's like, you're out. No more emails, no more calls.
Yeah.
I just can't tolerate that. It gets me very upset. There's too much money out there. There's too many good deals for somebody to be that salesy. They don't have an abundance mindset. Then it starts becoming a question of ethics. And then on the aggravation side for me, it's just simply is this someone I would enjoy working with? I'm not going to see you every day, but like at least at a minimum, I should be getting quarterly reports, right? Or occasionally you might have to call your investors when the thing goes wrong. If it's someone you don't enjoy getting a phone call with and they're calling you with bad news, it's just not going to be a pleasant experience. So I've walked away from deals that probably on paper will make money and look like a good deal. But if the personality profile just doesn't mesh well with me, it's just not worth it to me anymore. There's too many good deals out there. It's like, well, I'm not going to chase returns.
I love that breakdown. Thank you. That was phenomenal. And you're totally right about, depends on each investor. And that's one reason I actually love real estate, because there's, so many different asset classes, so many different business strategies, and what your investors want, kind of the returns they're looking for. You can typically make that happen, not all the time, but you can kind of make that happen depending on your business plan. And that's something that I just absolutely love about real estate investing. I know that real estate, the passive income was great for you. You also brought up the tax benefits, and that's something that you kind of hit on a little bit. You also mentioned something about cost seg towards the beginning of the conversation, but for the listeners, cost seg it's a cost segregation study. An engineer will come out, check out the property, and I'm no CPA, no cost seg guy, but we can put you in touch with people if you're interested. But a cost seg study basically looks at the property and breaks it down based on different personal items, and there's the government right now has 80% bonus depreciation. Again, not really going to get into that either, but it helps speed up the depreciation. Depreciation, I know a lot of high net worth individuals love depreciation and bonus depreciation because it just lowers the tax burden for that year. And then Andrew, what you had mentioned is the cash out refinance. I know a lot of investors love that strategy as well because it gets you money back totally tax free because it's not income, it's a loan. And so that's another reason that investors that people like getting into real estate. So I definitely appreciate you kind of bringing that up and breaking that down a little bit as well, because I think that's something that listeners may not know, that you can refinance a property tax-free in addition to getting tax benefits like depreciation, bonus depreciation. And there's also something called a 1031 exchange. It's well above my pay grade, but that's where you can legally defer taxes.
Yeah, this is where if you take your real estate journey to a certain point, you're really going to want to get a real estate friendly CPA.
Yep.
And this is nothing disparaging about CPAs, but all CPAs, just like every profession, are not created equal.
Right.
And especially when it comes to niches, you really want to get a real estate friendly, CPA, because if you say cost seg and they say what, that's usually a pretty good hint it's not going to work out. If they got to go Google it, it means it's not that they're a bad CPA, they're just not a good CPA fit for you.
Right.
So yeah, like you yourself, I'm not a CPA, you're not a CPA. We're not going to give, tax advice, but there's a reason why the wealthiest Americans generally have, the number's debatable, but let's just call it 25%. So we don't argue a Tiger 21 or some of these big groups that advertise portfolio mixes. There's a reason why they have a significant portion in real estate. And it's simply because there's no argument here. It is the most tax advantaged asset class. There is no asset class anywhere close to it. And you can argue whether it's a good thing or a bad thing. I would argue that's a good thing because you want more housing created. You want people doing flips and renovations. The quality of the housing gets better. So you want to encourage people. So, even opportunity zones are a little bit controversial, but again, it's like if you want more housing and you want people to improve housing, the only way you're going to get people right now to do affordable housing is with tax breaks.
Yep.
Now, whether or not that's a good or bad thing, I won't get into all that, but if you're being realistic and pragmatic about it, that's the only way, under the way things currently work, you're going to build affordable housing in most cities. So that's another way that investors can kind of play the tax angle, is to invest in an opportunity zone or an opportunity zone fund or a syndication in an opportunity zone. Yeah. My only, caveat to that is never let, the tail wag the dog. You should never be making tax the main focus of your investment, because then you could be taking on a bad investment.
Agreed.
I often say, someone said, what are your top 10 factors for a syndication investment? And sarcastically, I usually say the team. And then I'll hit them with the 5 other things like the market and all these things. And they think I'm being facetious, but I am and I'm not.
Yeah.
Because I'd much rather pick a middle of the road, okay city, not a bad city, but just a middle of the road, okay city that's just going to kind of chug along at the rate of national levels, at least has a diversified economic mix. It's healthy. It's got a pulse, but it doesn't have to be a high flyer. I'd much rather take Charlie and his good team in that city than, Pete in the hottest real estate market there is. And Pete's a knucklehead because Pete will lose me money.
Right. Charlie
will make me money in the okay market because he's good at what he does. And Pete, I know, actually, fortunately, I don't know any Pete's, so no one can get offended. he'll screw up. He's going to do a bad job. He's going to overpay. He's going to over renovate. He's not going to hire a good property manager. He's going to forget to buy a rate cap somehow.
Yeah.
He's going to do a bridge loan and blow up. So like, to me, when I say the team, I'm not being sarcastic. Like, it really does matter. So it's like all these things you're talking about, like picking a market and picking a property manager. If you're with the right sponsor, it kind of reduces some of those risks. So like, I've become much more geographically agnostic over time, because some of my better deals are in cities that, previously I wouldn't have considered.
Yeah.
But because the team was so strong and their track record was strong, I went with them. And in most cases, they've done very well.
Yeah.
So like, my arguably best performing deal is in a city that I normally would never have in a million years have thought I would be willing to invest there. But I had a friend who's invests with them, and he spoke very highly of them, and it's a person I respect a lot. So I was like, okay, I'll take the meeting. And they, they did their presentation. I was like, dang, these guys are really good. So I was like, geez, I don't know. I don't really like that city, but I like this team. So I went ahead and did the investment, and sure enough, it's arguably the best performing investment I have right now.
Wow, that's great.
We'll see when it goes full cycle, but I'm pretty sure it's pretty much a shoo-in. It'll probably be the best performing deal.
That, Andrew, you bring so much wisdom and insight to the show. I really appreciate it. As you were talking, I was actually thinking about one of my deals that none of the gurus would put on their top 10 or probably even top 50 markets, but the team is stellar, right? I'm actually in 2 deals with them, and both of those markets would not show up on top 25, 50 markets, whatever, and they're both doing phenomenal right now. And it just goes to show that, sure, I mean, those aren't bad markets by any stretch of the imagination, but they're also not the sexy cities at all. Most people you talk to that are in this business wouldn't say, oh, go invest here and here, but you can do well with a great team. So I really appreciate you bringing that up. You've brought a lot of wisdom to the listeners on kind of what to look for when investing in deals, why at least from your perspective, why it's a great idea to get into real estate and syndications, especially from the passive side. I know nowadays, growing up, I think our parents could have a job, and one of them worked and have a nice retirement, right? That's not the case anymore. Yeah. And, now you hear the term side hustle all the time. A lot of people have multiple side hustles or multiple jobs with income. And what I think most people want, and I'm definitely speaking generally here, but is that passive income, that time freedom to be their own boss. And I know that's kind of why you got into, or one of the reasons you got into real estate, besides just having a backup plan. And now you've scaled. And one of the great things about that is in single family, you kind of had to hire someone, or it was a full-time job. Now you do the upfront work of vetting the sponsor and the sponsorship team, understanding the market and the deal at a high level, but you don't have to be the one that's, analyzing the market every single week or month, every quarter. The team, the general sponsorship team is doing that for you. They're running it. And so for you, it is not 100% passive probably, but pretty darn close to it. And you can really scale that way because you're not the one that's taking calls from the property management company. So
yeah, that's really the big goal here, is to have more passive income and truly be, within reason to be passive.
Yeah. So what would your goals over the next few years be, do you think?
That's a good question. On the side, I've been assisting Douglas Dowell with his company.
Okay.
Make it very clear that's his baby, and I'm just an advisory role, and I enjoy helping him. And he's working on a debt fund. and a couple different syndications possibilities to come out with some different sponsors. I just like having fun at this point. Like I'll probably narrow down when it comes time to reinvest funds. I'll probably do larger investments with maybe less syndicators. But, I always would like to have a certain amount of diversification of not just syndicators, but also asset classes.
Yeah.
So, over time, depending on which asset class currently I view as being, of value, that's probably where I would go. And that journey still has a long way to go. There's so many niches, so many markets, so many operators to meet that, the runway is very long for me. I don't think I'd ever live long enough to learn every asset class.
Yeah.
So that to me is just really where it is. I mean, for me, everything is really about legacy at this point. I'm 47. Don't really have hobbies. I actually enjoy investing. I have a 14-year-old to send off to college and, leave a legacy behind for him. So most of my thought process is really more on leaving him things that, education and a mindset and skills, but also, like leaving him a passive income so that he can pursue whatever job he wants and not having to pick necessarily, this job pays more.
Right.
You should be doing if you're going to spend, 40 to 60 hours a week doing something, you might as well enjoy it and be good at it. I don't really ever want him doing a job just because it pays more.
Right. Love that. I found that out the hard way, unfortunately. Left a great job for a not so great job, but better pay. And anyway, but I definitely love that answer. All right, so we have a few minutes left and would love to ask you about a recent book that you've read or listened to that really stands out. Could be business focused, real estate, or self-help.
I'm going to give you one, but I didn't actually read it. But
Okay,
it's okay.
That's fine.
Never Split the Difference by Chris Voss was read by my partner, Douglas Dowell, and he absolutely loves the book. I mean, he's just constantly browbeating me to read it. I probably will buy it over the summer and read it, while my son's on summer vacations. He just beats me up about it all the time. The other one that constantly comes up among my inner circle is who, not how.
Yep.
And that expression has been a very useful expression for a lot of people that I meet, especially some of the younger investors that are overly focusing on like the nitty gritty, and they underestimate the relational or network aspect of this business. But those are two really great mindset books.
Yeah.
I come from an equities background. So I don't look at like crypto, stocks, bonds, real estate, other alternative assets. I don't look at them all as like individual fiefdoms. They're all part of an investing portfolio and they all have central themes. So for me, I still will read non-real estate books and learn things about real estate if your mind is open. So to me, the best book is a book called The Market Wizards.
Okay.
And there's a sequel called The New Market Wizards. It's just chronologically newer. And a guy named Jack Schwager basically interviews the best traders of a generation or a period of decades. And he's an incredible interviewer. And a lot of the questions are like, this terrible event happened. How did you have the balls to not fold and double down and then make gazillions of money? Or what were you thinking when you plugged all this money into this investment and no one else was looking at this asset class? You learn a lot about investing and mindset, listening to their successes, their failures, their backgrounds, their fears. Some of them talk about the personal sacrifices that it caused in their life. Really was becoming a billionaire worth it to some of the gentlemen? One was laughing, saying, "It's great, I'm a billionaire, but I've been divorced 3 times and I have a bad heart."
Wow.
It's like, great, I got all this wealth. It's like, what am I going to do with it all?
Yeah.
And some people can become a billionaire and be quite happy. Me, I have no interest in becoming a billionaire. I don't really see the marginal utility in my life. Buying a Lamborghini, flying a private jet just doesn't really particularly interest me. Don't get me wrong, I like money just like everybody else, but would you be willing to chase it to the point that it would cause, health problems or family problems? I'm not willing to do that. And that's not to say you can't have wild success. I'm just saying, like, you should always be looking at the cost benefit analysis of things. And, I meet too many older gentlemen that definitely would give back much of their career success, not to, be estranged from their children or divorced, for instance. Or, how many people do have a law partner that died at 64 of a heart attack, and they're thinking, man, I wish he would have delegated a little more.
Yeah.
Played a little more golf and maybe made a little less money, but he'd still be alive. So these are the things old farts think of when they're 47. You're too young to worry about this stuff.
I've not heard of the Market Wizards, but I will check that out. Who Not How was huge for me. And then Never Split the Difference. I actually listened to that on audio when I was driving or on walks and stuff like that. Great book. So I would definitely recommend. I'll be on Douglas's corner on this one, but definitely recommend Never Split the Difference, even if it's audiobook. And then to the listeners, Who Not How was great as well. And Market Wizards, like I said, I'll check that out.
The thing I would tell your listeners is, like, there's a point to read books and to watch the podcasts, but that's like only phase one. That's like just consuming information. There's going to come a time where you're going to have to get out of your comfort zone and actually talk to people.
Yep. And
meet other people and do all the networking, all the dirty work that some, maybe an introvert doesn't like. And, my answer's always been tough. Life is about growth and about being uncomfortable. If you really want to go far in real estate, and you know this, Charlie, it's all about relationships.
Right.
Very clearly, I own 30 investments. My best investments, generally speaking, almost without exception, are referrals. Wow. So as much as I might think I got my pulse on what's going on and learning who's a good sponsor and analyzing deals, the bulk of my better performing deals are all referrals from other investors.
Wow.
So if you think you're going to sit in your room and not talk to people and you're just going to Google everything, you're making a terrible mistake.
Yep. Agreed. How can people reach you if they want to talk?
Oh, okay. The best thing to do is actually just go on LinkedIn. And as you were making fun of me, I'm a little hyperactive on LinkedIn. I post probably multiple times a day. Easy to get a hold of me. Just send me a connection request. I accept all connection requests, even the fishy ones. I just block those ones later. I probably get 3 Asian women looking to be my girlfriend a day. It's very frustrating. And about 3 or 5 crypto and Forex guys a day, and they just eventually delete or block them if I have to. So I accept everybody, so don't worry about that. And I'm always happy to discuss. If people have questions, I like talking real estate.
Yeah.
The best thing, like for me, I talked to Joe Giolacci, who's a guy I really admire. He's another investor, or Josh Wagner. And oftentimes we'll compare notes and say, hey, we're looking at this. What did you think? And it's really beneficial to have that inner circle of people you trust that can just talk about investments, and they can go through the pros and cons. And there's times they'll bring up an issue, you're like, geez, I never thought of that. I'm out. That's not for me.
Yeah.
That kind of thing.
That's great. In the show notes, Andrew, I will link your LinkedIn profile, so make it a little easier for people to reach you. Do you have a website that you want to plug?
No, the best thing to do is just go on LinkedIn and find me.
Okay, perfect. We'll put that in the notes. Andrew, I know I've gained a ton of insight from you. I'm sure the listeners have too, but really appreciate you being on the show, sharing your wisdom, your wealth. You're a wealth of knowledge. Thank you so much for being here.
Oh, it's my pleasure, Charlie. It was really good to actually hang out with you. It's been a while since we've seen each other on the Zoom calls, so it was good to kind of catch up.
Yep, sounds good. Thank you, Andrew. Thank you for listening to today's show, brought to you by H&K Investment Group, your home for passive investing. If you want to learn more about how you can invest with us, please check out our website at hkigllc.com. Don't forget to like this episode and subscribe to our podcast. Please leave us a review to let us know how we are doing. Feel free to connect with me directly on LinkedIn or Facebook. As always, I'm your host, Charlie Hardage. Catch you next time.